Governments around the world have been quietly attempting to restore confidence in the real markets before the rug is pulled up from under them. Soon we'll see a strong deflation enter the system as more and more people flee from their investments in paper assets, cash in on their retirement accounts early, and head for the hills. The reaction to this will certainly be from central banks with negative interest rates on one hand and additional QE from the other. Tables are turning. You came here for the truth, so let me unveil that for you. Let's look at China's foreign currency reserves dropping by 100 billion, among other things. Let's get into this first. Iran wants to recover tens of billions of dollars that is owed by India and other buyers of its oil in euros. And it's billing the new crude sales in euros too, looking to reduce its dependence on the US dollar following the sanctions relief. So this is very important to note because you can see that Iran's doing business, they're selling oil, and they don't want US dollars. The US dollar, of course, is the reserve currency of the world. Commodities generally being traded in that US dollar, but here is Iran saying, we don't want the US dollar, we want euros. Of course, it really does no more than make a statement, and that's exactly what they want. In our invoices, we mention a clause that buyers of our oil will have to pay in euros, considering the exchange rate versus the dollar around the time of delivery. Very important information here to keep a lookout on this, as well as the currency swaps that are taking place with China. Very important to see what's happening here, as the dollar is seemingly strong on one hand, but many of the nations don't want to do business, China in particular. Speaking of China, China's foreign currency reserves plunged by 100 billion in January, the People's Bank of China reported. Now, before I get into the article a little bit here, I want to note the obvious. It says this: at $3.23 trillion, China still has the world's biggest reserve of foreign currency holdings. So it's important to note here that you see, obviously, 100 billion versus their 3.23 trillion isn't exactly a big swing. But if it continues on a trend, that's the kind of thing that we need to pay attention to. We need to see it as it happens. We're not going to be able to react to it if those numbers change dramatically. And this goes not just for the currency reserves, we're looking at everything else too. China has been running down its vast foreign currency reserves in an attempt to boost the value of its own currency and stem a flow of funds overseas. Interesting the way this happens here, and you could see many other countries doing the same thing, or increasing, decreasing. We have to keep an eye on it, but what I would say to you is not to look at the small fluctuations that are occurring, but look at the long-term trend. Let's look at this. Auto giant Ford is planning a new assembly plant south of the US border. It's going to sharply increase its factory output from Mexico just months after signing a labor deal. That's right, it's going to double the amount of work it's doing outside of the US borders. And why is it doing that? Well, obviously, they can increase their corporate profits. Looking at cheaper foreign labor, you're looking at a developing nation, and this simply is a means for these corporations to make more money. There are many solutions to this, let's say suggestions of solutions to this. I would just say that everything is in the corporation's favor to move overseas. There are every reason to do so. You have all of the tax loopholes which exist. You have lower taxation in these countries. You have less regulation, less healthcare laws. Everything points to move your company overseas, shut down the doors here, move it overseas. The only problem is if everyone is unemployed, Who's going to buy your vehicles other than those people in those developing nations? I wrote about it in my book, saying this: when General Motors plans to invest $1 billion in Brazil, you know that the business is continuing to move overseas, further decreasing manufacturing in the US. Cities that relied on manufacturing of vehicles are a dangerous bet for the foreseeable future. So when you look at an area like Detroit, you can see exactly what the near and mid future look like for there. It's not pretty. This is out of Reuters. Venezuela central bank has begun negotiations with Deutsche Bank to carry out gold swaps to improve the liquidity of its foreign reserves as it faces heavy debt payments this year. Now, they're selling off some gold here, and what I would like to know from this is, obviously this is important to note, but when people are indebted, they're going to be forced to sell off their assets. And that's what this really is about. Gold happens to be in this situation. What if people who are purchasing their assets, whether it's precious metals or anything else, they get into a situation where they are suffering and need to sell those assets in order to basically pay their bills, have their current existence continue. This is what I worry about. So many people are purchasing into precious metals. They're purchasing a lot of things to protect themselves, but it's very important, I believe, to get out of debt. Number one, get out of debt. A lot of people don't agree with me on that, but I have to believe that this is the weapon that they will use in order to bring us down. Some suggest getting into as much debt as possible, but I believe that the system that they have set up, the bankers, the central bankers, the technocratic elites, set this system up on purpose to be there for and holding all of this debt. We will be the ones that are suffering because of it. They create it, we are forced to hold it, and the less of it that we do hold, I believe the less control that they will have on us. So that's my message for that. And then last but not least, just wanted to go into this is talking about the primary dealers' treasury holdings. Essentially, according to Bloomberg, the buildup in the 22 primary dealers' treasury holdings concentrated in maturities less than 6 years may also be a signal more sales by central banks. Interesting to see that all taking place right here, as you have to wonder who is going to be able to essentially step in and be there as the last resort. The Fed's owners, the primary dealers, refuse to play along with the Fed's transitory narrative as a treasury bond position in the longest since 2013. That's all for this video. If you found it informative, please give me a thumbs up. And last but not least, if you found the video informative, you'll definitely find my book, The Money GPS, even more informative. You can flip through it. If you head over to Amazon, they have a look inside feature, which allows you to flip through the pages of the book to see if you like it. Take care.